Picture this. You're re-scrolling through your social media feed, when suddenly you see everyone talking about the latest hot stock. It's skyrocketing, and your friends are bragging about their gains. Your heart races as you consider jumping in, afraid of missing out on easy money. But just as quickly, rumors start swirling about potential fraud, and panic sets in. The stock plummets, leaving many investors shell-shocked. This, my friends, is the power of emotions in the financial markets. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving into two powerful forces that shape market movements: FOMO and FUD. These acronyms might sound like internet slang. They represent very real psychological phenomena that affect both small-time traders and big-time investors alike. Let's start with FOMO, the fear of missing out. In the financial world, FOMO occurs when investors feel an intense pressure to buy because they see others making profits. It's that nagging feeling that if you don't act now, you'll be left behind while everyone else gets rich. We've seen this play out in countless market rallies. From the dot-com boom of the late 90s to more recent cryptocurrency surges, take the Bitcoin frenzy of 2017, for example. As prices climbed higher and higher, more people rushed in. Driven by stories of overnight millionaires and constant media coverage, your neighbor, your coworker, even your grandma started talking about Bitcoin. This social proof, combined with greed and nonstop hype, pushed many to buy at sky-high prices, often using money they couldn't afford to lose. But FOMO isn't limited to digital assets. We've seen similar patterns in housing bubbles, where the fear of being priced out of the market forever drives people to stretch beyond their means to buy property. The psychological triggers are the same. Seeing others profit, constant positive reinforcement from media and peers, and the fear that this might be your only chance to get in on a good thing. Now, let's flip the coin and talk about FUD fear, uncertainty, and doubt. While FOMO drives prices up, FUD can send them crashing down just as fast. FUD refers to the spread of negative information, whether it's based on facts, exaggerations, or outright lies, that leads to fear-driven selling. We've all seen how a single negative news story can tank a company's stock price. Remember when Elon Musk smoked weed on a podcast and Tesla shares dropped 9% the next day? That's FUD in action. But it's not always tied to a specific event. Sometimes it's a general sense of unease about the economy, political instability, or rumors of impending regulations that can spark a sell-off. What makes FUD particularly dangerous is that it can be weaponized. Market manipulators sometimes deliberately spread bad news or exaggerate minor issues to create panic. Their goal? To buy assets cheaply when everyone else is selling in fear? It's a tactic as old as the markets themselves, but social media has amplified its potential impact. So how do FOMO and FUD actually shape market movements? Let's look at a few case studies to see these forces in action. Remember the Bitcoin boom and bust of 2017, 2018? As prices approached $20,000, FOMO reached a fever pitch. People were taking out mortgages to buy Bitcoin, convinced it would keep rising forever. But when concerns about regulations and exchange hacks started spreading, FUD took over. The price crashed, wiping out billions in paper wealth and leaving many newcomers burned. Or consider the GameStop saga of 2021. What started as a discussion on Reddit turned into a full-blown market mania. FOMO drove masses of retail investors to pile into GameStop stock, hoping to stick it to Wall Street short sellers. The price soared from around $20 to nearly $500 in a matter of days. But as quickly as it rose, FUD set in. Fears of missing out on gains, combined with uncertainty about how long the rally could last, caused many to sell, sending the price tumbling back down. Even the broader market isn't immune to these emotional swings. The COVID-19 pandemic provides a perfect example. In March 2020, as the virus spread globally, FUD gripped the markets. The S&P 500 plunged 34% in just over a month as investors panicked about the economic impact. But then, fueled by government stimulus and optimism about vaccines, FOMO took over. The market not only recovered but reached new highs, with many wondering if they'd missed out on the rebound. So how can you protect yourself from getting caught up in these emotional roller coasters? Here are a few strategies. First, learn to identify emotional decision-making. Are you buying because you've done your research and believe in the long-term prospects, or because you're afraid of missing out? Are you selling because the fundamentals have changed, or because everyone else seems to be panicking? Being honest with yourself about your motivations is crucial. Second, build a solid investment plan before you need it. Set clear rules for when you'll buy, sell, and how much risk you're willing to take. Having a plan in place makes it easier to stick to your strategy when emotions are running high. Diversification is another key defense. By spreading your investments across different assets and sectors, you're less likely to be overly affected by FOMO or FUD in any one area. Remember, not every investment needs to be a home run. Consistent base hits can add up to significant gains over time. Perhaps most importantly, learn to filter out the noise. In today's 24/7 news cycle and social media landscape, it's easy to get overwhelmed by information. Not every tweet, headline, or influencer post deserves a reaction. Focus on fundamental analysis and long-term trends rather than short-term fluctuations. To wrap things up, let's recap what we've learned. FOMO and FUD are powerful psychological forces that can drive market movements as much as, if not more than, actual economic data. FOMO pushes prices up as investors rush in, afraid of missing potential gains. FUD can cause rapid sell-offs as fear and uncertainty spread. Both can lead to irrational decision-making and significant market volatility. By understanding these forces, developing a solid investment strategy, and keeping your emotions in check, you can navigate the markets more effectively. Remember, successful investing is often about managing your own psychology as much as it is about picking the right assets. We'd love to hear about your experiences with FOMO and FUD in the comments below. Have you ever made an investment decision you later regretted because of these emotions? Or have you successfully resisted the urge to follow the crowd? Share your stories, and let's learn from each other. Till next time, this is Economy Unpacked Daily, helping you navigate the complex world of finance, one video at a time.